Russia's invasion of Ukraine rattled global financial and energy markets, causing oil prices to spike and financial instruments to also fall after Russian troops moved into Ukraine by air, land, and by all means necessary, according to some. Russia's military action in Ukraine has also had a significant impact on the global markets, as commodity prices have also been volatile this season. Bond yields are also moving up, and equity markets have seen a significant decline. Amid the rising tension, the Nigerian capital market went up marginally by 0.1% in February's trading performance, but experts say it was not an indication that Nigeria will not share the negative repercussions of the Ukraine attack. Now, meanwhile, global markets are closely following high-profile meetings in Brussels today, with the regional investors keeping a close eye on developments in Ukraine and key meetings of NATO, EU, as well as the G7 leaders. Now, to discuss more on this development and its impact on the capital market, I have joining me virtually investment professional Ayo Dejebo. Thank you very much for joining us on the show this afternoon, Ayo.
For having me. Good afternoon.
Let's now start our conversation with the impact of the Russia-Ukraine crisis on the capital market, raising market volatility, adding to inflationary pressures by disrupting exports of oil, natural gas and wheat from Russia and Ukraine. Really, now the interplay in the commodities market has also been one closely watched by investors. What are your thoughts on the plunge and then the rebound and seesaw patterns we've seen within the capital market and beyond?
Okay, thank you very much. And I would like to start with the global market. So we would see what we had seen even before the war broke out between Russia and Ukraine, was that with the anticipation of the rise in the interest rates, we saw market was already reacting, and they were already seeing rebalancing of portfolios. So a lot of stocks were seriously beaten even before then. And we now saw the war now compounded the situation. But investors have also seen that this would be maybe short-lived. I would say maybe short-lived. And as a result, they are trying to position ahead. For long-term investors, it's always when market is significantly down that that is best to take position. So what we have been seeing in the last 1 or 2 weeks was mainly as a result of investors taking long-term position, because fundamentally most of the stocks are still very strong. And coming down home, it's good for us to note that over 75 to 80% of transaction or activities in the Nigerian stock market being carried out by domestic investors. As a result, we didn't see a lot of sell-off from foreign investors because of their limited participation. But we all know that a prolonged war, and even with the current rise in commodity prices, will impact the companies that are currently listed. So that's we've been seeing a slowdown in terms of investment, and with the anticipation that there will be significant increase, or there will be a major increase in interest rate due to increased borrowing from the government. Investors are also a bit conservative regarding that. So by and large, investors don't like uncertainty. We'll be seeing those volatilities, but we would always say that presents opportunities for long-term investors, because for strong and fundamentally strong stocks, it's always the time when stocks are really down that is good to hold them for long term, once you know that there's significant potential for the stocks or for their sector where they operate.
Now, players within the UK, the United States, and even in Africa are keeping their fingers crossed and watching the global market, especially as we are having meetings in Brussels today. But in the case whereby this crisis lasts longer than expected, do you think investors will still be able to hold or still keep their focus, not lose sight of the long-term opportunities that the international stocks may offer?
Okay, thanks. I think if it's prolonged, it would impact on global growth. And once it's impacting on the expectation of the economic growth globally, it means it would impact on those companies. And that may even limit the chances of the US Fed and other global central banks to raise the rates. That, we've seen it last week. We saw the US Fed raise the interest rates to a band of 25 to 50 basis points. And we also saw the Bank of England increase it for the third consecutive time since December. But if this is prolonged and commodity prices remain very high, it's really going to impact on inflation and would impact on the purchasing power of the individuals, and the company's cost of production would also increase, which would mean that it would reduce their profitability. So we know all hands are on deck, everyone watching closely, and if this really it's really prolonged, especially you look at the Euro countries that depend significantly on Russia, is it for gas and for other major raw materials. So it's really going to impact on their growth. I think just yesterday or early this morning that the President Putin is asking that for Europe countries, for some of the countries, should begin to pay for gas in rubles. So that would really will also affect some of those countries because of the availability of the currency. So by and large, no one wish for this war to be prolonged, because even domestically it's also going to impact us in terms of energy prices, where we pay a lot of subsidies, and sadly we are not producing much. And also, you also want to note that the cost of wheat would also impact us. Bread, which is and other staples, which is what a lot of Nigerians consume, would also have that major impact. And lastly, you recall that not all the petroleum products are regulated. So you would the likes of gas, kerosene, diesel as almost more than doubled in terms of prices in the last 8 weeks. So that would really have significant impact on both the global economy as well as the domestic economy if this war is not tamed in time.
Now, Ayo, we had some concerns raised by the International Monetary Fund for Nigeria and other developing countries in terms of increased tightening when it comes to loan accessibility, because for most emerging economies like Nigeria, we rely for assistance and loan support from the international economy. Do you think we are utilizing now the local capital market here, especially as much as possible when it comes to funding critical infrastructure projects and even other developmental agenda? Yes, we have the likes of Infraco, but is that enough?
Thanks. Very good question. I don't think we're utilizing the capital market enough for major projects. I would always cite this example of the Sukuk bond, which has shown that we can do it. We can rely on using the capital market for major projects, and it creates a lot of transparency. So when you travel around the country, you see some of the roads that the Sukuk funding has been used. So I see no reason why government should not have like a project bond that would declare that this bond would be the funds raised from this fund will be ring-fenced and will be used for projects. But we're also aware that there's been significant revenue challenge, and a lot of the borrowings are not going into capital expenditure. So it will be difficult for the government to carve out a project bond, and that is a major setback. It's a major setback for us. The capital market provides long-term funding. What we are currently seeing with the low interest rate environment in the treasury bills market, we've been seeing a lot of corporates issuing commercial paper, which provides cheaper access of revenue of loans for them, or funding rather, for most of those companies. One would also expect as we get clarity, as there's more stability for expansion, the capital market will provide long-term funding in terms of bonds for a lot of these companies because most of the banks don't do very long-term lending. So we believe that this would also create opportunity for corporates to also issue bonds, which can be used for capital projects for expansion. But I know a lot of the companies too are also skeptical about demand, with a lot of pressures on consumer wallets, with the high inflation, cost of production also going up, which is reducing the demand. A lot of companies are also not encouraged to expand because capacity utilization is reducing on a daily basis due to lower demand, which eventually will lead to loss of job. And we also know that implication on insecurity when unemployment is high.
Exactly. Mr. Ego, we are wrapping up our conversation now. At the start of this week, during the conclusion of the Monetary Policy Committee of the Central Bank of Nigeria meeting, we had the retention of rates left unchanged, and we also had the commendation of the equities market. Now, going forward, we are almost wrapping up the first quarter of this year. How do you see the markets also responding to all of the playouts we are seeing, both locally and also in the international front, say, after this quarter, in the short term?
Okay, thanks. I think there are several factors that would impact negatively on the stock market. The first one is the expectation of higher interest rates. It means that dividend yield or the return on the capital market will become a bit less attractive. Secondly, we're also aware that in terms of the political risk, we are raising towards the 2023 election, and there will be a lot of uncertainty because what we all expect is that there will be a new president that will emerge. So investors would like to understand the policy direction of the new president before they also try to invest. And for the foreign investors, with the expectation of higher interest rate environment in the developed markets, it will also prolong the time that we'll begin to see FPI come into the country, which will reduce the FX liquidity even for the CBN. So by and large, what we advise investors to do is to try to buy in tranches. We say buy the dip, but no one knows how deep it can go. But we don't expect high volatility because domestic investors dominate this market. But there will be opportunities for long-term investors, as we know that most of the companies that are listed are mostly resilient, and they will try to navigate around this storm.
Thank you so much for your time on the show this afternoon. It's been a pleasure speaking with you, Ayodeji Ebo. Do have a wonderful afternoon.
Always my pleasure. Thank you.